Good day, traders. Welcome to K5 Trading. In this 5-part video series, we will try to explain the institutional trading psychology. Once you understand the institutional trading behavior, you will see the significant improvement in your trading result. We will start our series with this single candlestick, and we try to understand how the opening, closing, high and low of the candle help you to understand what's the institution's intention in a particular candle. So let's start. Before, just a normal disclaimer as required by the regulatory bodies. This video is presented only for educational purpose, and it is not a recommendation of buy or sell at all, nor this is a financial advice. You can also join our Discord server where we provide the updates on the frequent basis on ASX, BSX, US stocks, NSE, Forex, cryptos, and commodities. The joining is free. There is no charge for that one. You can also follow us on the social media. You can subscribe to our YouTube channel, which is K5 Trading. You can like our page on the Facebook, which is K5 Trading, and on Telegram, you can join us at K5 Trading. Okay, so before we start with the institutional characteristics of candlestick, the three things we will discuss. Number one, what kind of data points we require for the construction of the candle and how the candle actually construct. Then we will talk about the institutional footprint, how we can find those footprint on a particular candle. The key activities of any institution. The key activities of institutional trading are the following: open new positions, buy or sell, accumulate, distribute, protect initial positions, and stop the market at certain level. Look at the left to identify this behavior. On the chart at various swing point, you will easily identify the point of interest where the institutions have their interest. They can also add on the additional positions, locate liquidity and inducement, and chase the liquidity and inducement. Liquidate the original position. They also buy to sell, and they also sell to buy. They always buy at the discounted zone. They always sell at the premium prices, unless their intention is to trap the retail traders. Okay. A candle is construct of the two data point: open, high, low, and close. When the opening prices is below the closing prices, or when the closing prices is above the opening prices, that means that this candle is a bullish candle or the green candle. When the closing prices is below the opening prices, that means the candle is a bearish, and that could be a red candle or whatever the color you like to choose. There are two other points up here, which is high and the low of a candle. High and a low, the difference between high and the closing prices or the opening prices is called wick. And the difference between the upper wick and the difference between this opening or closing and the low of the bar is called the lower wick. The size of the lower wick and the higher wick, they are significant in understanding institutional behavior and institutional intentions. The body of the candle is also important. We will look at this one into the next slide. Okay. The range from high to the low is called the range of the candle. So this is the range of the candle. And this is your opening or closing. Opening or closing. If it's a bullish, then it's a closing here and opening is here. And if it's a bearish, then your opening is here and your closing is on the downside. So this area between the opening and the closing prices is called the body of the candle. The body of the candle signifies whether institutions like to be bullish or bearish, or whether they are interested in the market or they are active in the market. When the body is a 60% or more of the range of the candle, we call this is a power candle. A power candle signifies that institutions like to continue or institutions are very active in the trading, and that's why either they're pushing the prices higher or they're pushing the prices lower. As we mentioned earlier, that institutions never ever buy at the premium and they never ever sell at the discount. So if we can draw a 50% zone in the high and the low of this one, this is our premium, this is our discounted zone, and this is our premium zone. An institution will always buy at this area and they will sell at this area. They can also buy, they can also sell in this area if they want to actually buy the long position. And this is we call sell to buy. Why they want to sell it here? They are selling the market at the bottom in the discounted zone where they normally buy. They don't sell it here. The reason why they are selling here in this discounted zone because they want to trap the retail traders, indicating that the market is going to go down. So when the retail traders, they start selling, panic selling here, they start buying and then they push the market upside. So if for the larger position, if they want to hold it, this is their buy zone. The smaller position where they want to trap the retail trader, that will be a selling positions. And they will have a small positions here. The similar things happen in the above of this 50% area. They will sell up here to book the profit, or they will actually start, they will book the profit, or if they want to bring the prices down. They will buy here in a small quantity in this area to trap the retail trader thinking this market further want to move up. So if you understand the psychology of this one single candle, and you see that the above this candle, there are some small bullish activities, you can assume that the institutions are trying to trap the users and they want to bring the prices down once they will trap them. When you see on this below the 50% zone, when you see the small selling activity here, you can assume that the institution are trying to trap the retail traders for the panic selling so they can buy from them. These two concepts, if you understand, it will help you to reduce your losses significantly. Never ever sell in this zone, which is your discounted zone. Never ever buy in this zone, which is your premium zone. Always buy up here on the discounted zone and always sell in the premium zone. Right. The closing of the candle signifies that if it's closing in the upper part of the body, let's assume that if they divided the body in the 3 parts, you can divide in the 4 parts if you like. But if you divided the body into the 2 parts, and if your closing is in the upside or the upper part, that means that the market is a bullish and institutions are actively trying to push the market upside. If the closing is in the low sides, that means that institutions are actively selling in this market and they're trying to push the prices down. If the closing is in the middle, that means that's initially the institution, either they actually push the prices upside and then they got a lots of selling coming, or they were selling and lots of buying pressure coming in. So when the prices actually close in the middle, that signifies that the market is in the market, the institutions are quite active, both sides of the institution, who are long and who are short, and you need to wait for the market to take some kind of direction before you can actually make a trading decision. You can still make a trading decision because if the closing is the low and the market is coming in this 50% zone, then you know that this is the discounted area for the institutions to buy. So in this zone, you can wait for the confirmation and then you can go long on this one. If the prices if you think this market is bullish or is bearish, then you can wait for, you can look at around here a signal or a confirmation or some kind of behavior from the institution that they want to short the market. You can also check all those kind of things with the volume as well. But in the Forex market, volume is decentralized. That's why we do not consider volume as a good indicator. So by locating the closing of the bar, we can understand the intention of the institution. Now let's come to the wicks. The longer the higher wick or the lower wick, that signifies that the price was very, very efficient in this area because there were lots of buying and selling pressure. That's why it's created a long wick. Below and above the long wick, we can see lots of stop losses and new orders. And that's why we consider this area as a liquidity pool. And we expect the institutions will actually chase those liquidity pool and then they will go into the direction as they want to go. So this was the very short video explaining you how you can actually check with the single candle how the institutions actually see the market. So always look for the those four areas: closing, the size of the wick, the body of the candle, and the range versus body. This should be the 60% if the institutions are active. If less than that one, then you need to compare with the previous candle. Body of the candle is this one. Is whether blue or green, wick, and the closing. So these are four things. If you try to understand in each of the candle, you can understand. So very, very basic of the institutional techniques and the behavior. There are lots of other things, but this is just to start with the basic concepts. Now let's have a look into the chart of this concept. We go to the daily time frame. And I will delete all my marking previously, which I had drawn here. So this is the Dow Jones, and this is the Friday closing. And I'm not running on any hindsight market. I'm just running the last candle. I'm just trying to show the last candle and expectation of my next move tomorrow or the Monday when the market will open. Okay, so we got a high up here and we got a low up here. What does it mean? That's this area is right up here, the low wick. That's we can consider the below is here is the liquidity. And this area here as well, we can consider there is some liquidity, right? Now, after marking this one, what we want to do, we want to go into the lower time frame, likely 2 time frame lower or 3 time frame lower. So from daily, we go to the 1 hour. In the 1 hour time frame, you can see that's the lower liquidity part we actually have captured. It hasn't been swept yet, because we can see some orders around here, and around here. So if we want to buy in this market, how do we want to buy in this market? From this point onward, or this point, wherever the swing point is, from this swing to this swing, we like to draw our Fibonacci, and our expectation that's below this 50% mark, we would like to buy if the market comes below this one. Now, just below the 50%, I can see this long wick up here, the lower long wick. That means there will be some liquidity around this area as well. So I should actually wait for the sweep of this liquidity. And maybe when the market reach in this zone of this liquidity area, I will actually try to judge that's whether I can get any signal for the reversal, or I can see the signal for the end of the correction, and I will make my decision accordingly. So that's what's the very, very simple, high-level basic how to read a single candle, not the multiple candle, not the chart at all. In upcoming videos, we will also explain how to look at the market structure in very, very simple terms. This is all I got for you for today. That was the very, very basic lecture, or very, very basic lesson on how to see a single candlestick from the institutional point of view. On our next video, we will focus on the market structure, and we will try to understand how the market structure can help us to refine the concept we have learned today. We will start with the very, very basic concept and gradually we'll go to the advanced model. So the learning gap is automatically filled. If you like our video, please subscribe to our channel and we will see you in the next video. Happy trading and bye for now.